Today's lesson, we're going to focus our attention on the maturity guarantee of an IVIC. You will recall that the IVIC is an individual variable insurance contract. Now, sometimes you see the word segregated fund, sometimes you'll see the word IVIC, but basically it is an individual variable insurance contract. Now, in order to fully comprehend what I'm about to say, because it can get kind of confusing and everything, is please download the fact sheet for this particular sheet, and that way you can follow along with me, because there's a lot of writing basically, so it'll be easier for you to follow along if you, in actual fact, download the fact sheet. Now, in order for us to talk in terms of maturity guarantee, we have to talk also about the two different kinds of maturity guarantees, the two different kinds of policies that are actually available. But first of all, remember that maturity in an IVIC means 10 years. And it means 10 years from the last deposit. And that's very, very crucial, okay? It's from the last deposit, not from withdrawals. Withdrawals do not have any kind of impact on the actual 10-year maturity, only deposits. So the last deposit is what the insurance company will look at, and then from that last deposit, they say 10 years down the line. That all said, there are two different kinds of IVICs. The first one is what we call a policy-based guarantee, okay, policy-based 10-year guarantee. And in order to get sort of the sense of what we're talking about here is that in a policy-based, if you deposit, for example, $1,000 one time, and then you have a series of payments, let's say, of $100 every single time, what happens is that on policy-based, everything is 10 years from the date of deposit to December 31st. So, for example, if you gave us the money here, let's say in January of the year 2000, just for easy math, okay, on January 2000, you gave us this $1,000. Then what will happen here is that this will actually go to December 31st, 2010. In other words, it's 10 years. But you might have given us the money in January 10th. Okay, so it doesn't really matter. The point is that at this point here, okay, all that happens is that this is the deposit that was made, and it moves everything to December 31st, 2010. Then you came along and you gave us, let's say in February, you gave us of the year 2000, you gave us $100. At this point, that $100 then moves everything over to, again, December 31st, 2010. So therefore, if you see on your chart, you'll see a series of payments. However, I want to draw your attention to a very important, the last line, basically, and let's go now to January, let's say 2001, you gave us $100. Again, this was your last deposit. Now what happens is that it will, the maturity will be December 31st, 2011. So I want to draw your attention that when we're talking about policy-based, the first thing to note is that it's always December 31st, always. So in other words, it only has one anniversary date, not two anniversary dates or 300. It's one anniversary date. It all comes due. So then what they do is they basically say, when was the last time you gave us money? In our example here, you gave us money in January 2001. You gave us $100. So therefore now the maturity date is no longer 2010. It will be December 31st, 2011. So everything moves over to that December 31st date, the following, the 10 years from that last deposit. If all the deposits were made in the same year, then obviously it would always be 2010. But the moment we went into a new year, it automatically then shifted everything over to the new year, being, of course, 10 years down the line, 2011, December 31st. So key number one is that on a policy base, it's always December 31st. And it's from that last deposit at all times. Now, the sister to that, basically, is what we call the deposit-based. Now, this is a little bit different. In a deposit situation, and let's go back to our example. You gave us in January of 2000, you gave me $1,000. Well, then, and let's say it was January 10th, let's say, okay, up to 2000, you gave me $1,000. Then it will become January 10th, 2010. Notice that it's exactly 10 years from that deposit. In other words, it's not December 31st. It's exactly 10 years from the date of actual deposit. So now, in February, February 10th of the year 2000, you gave me $100. Well, then it becomes February 10/2010, you get, and is your maturity date. So once again, it's exactly 10 years. So the difference between the policy-based and deposit-based is policy-based says, when was the last time you gave us a deposit? On that date, we add 10 years to it, and we move the anniversary date to December 31st. Deposit-based, we're saying also when you give us the last deposit, but notice that each deposit, so you may want to take a look at a deposit-based as if it was, in fact, you buying a brand new contract every single time. And so therefore, you're actually moving the maturity date every time you make a deposit. Each one of those deposits will have their own 10-year maturity dates. So when you come out to take the money out at the other end, you'll find that in actual fact, your money is maturing at different times all along. So therefore, it's a bit of a different way of pricing the product, but those are the two systems that they use. Policy-based, December 31st at all times from the last deposit. Deposit-based, it's always 10 years exactly the date that you actually gave us the money. So you have multiple anniversary dates, you might say. So you must know the difference between those two, because you will get this kind of a question on the exam.